So I was, I was happy to come on and speak a little bit about some of, the access to capital mechanisms that are available through Wintrust and Beverly Bank to support your businesses. One of the things that's really important as you start these conversations about accessing capital, is making sure that the financial institution understands where you are in the process, right? Because that allows them to kind of tailor or identify products that may be most appropriate, for your business in real time. It's also important to understand specifically what it is that you're trying to acquire, or better yet, what you're going to use the funding for, right? So whether it's working capital that you'll use to front fund the cost of projects to keep folks on payroll, or to, or if it's you actually acquiring a vehicle, right, or equipment. The bank typically funds those different needs at what they call different loan to value thresholds, right? And so what I thought we'd do is we'd start with a more generalized product, right, in terms of access to capital, and then move to more bank specific ones. So kind of a catch-all product that's available for businesses at varied stages of development. So whether you're a startup business, you've been in business for 3 years, or you've been in business for 10 years, you should be able to kind of explore options through two mechanisms. One is a traditional micro lender. There are a few in the city. Greenwood Archer Capital, which was formerly Chicago Neighborhood Initiatives, and Allies for Community Business, which was the former Axiom. Both of those specialize in products that are tailored for folks who have trouble accessing funds from traditional financial institutions. So they provide micro loans. Typically, they provide term debt. But if you have a relationship with a bank, and your business is in its infancy, or if you don't have a lot of experience, one product that you should discuss with your lender is what they call an SBA Express loan, right? So an SBA Express loan is a product that typically goes up to about $250,000, right? It's got a minimum threshold of about $50,000, but you can use it to purchase equipment. You can use it for working capital. You can use it to refinance debt. You can use it to acquire real estate, right? So if you guys are interested in acquiring a garage that you need to store your vehicles that you want to own as opposed to paying rent, that product is available for that. An important thing to remember is that product, especially if you're a startup business, is going to rely heavily on the integrity of your projections, right? So you being able to anticipate what your revenues are going to be on a monthly basis, and then anticipate what those offsetting expenses are going to be for the same period. Typically, for a startup business, if you are, looking at a working capital loan or a term loan, they're going to want 24 to 36 months projections, and the projections are going to have to, make sense. So you're going to have to do what they call validating your assumptions, right? So how many loads do you anticipate on a weekly basis, extrapolated out to the month, extrapolated out to the year? How do you know that you're going to be able to generate that much activity? Well, I've already signed a contract with Waste Management, or I've got a contract with the city of Chicago, or whoever that is. And those contracts are going to guarantee me so many loads, a month. All of that granular detail. The bank is going to work, especially with the SBA products, is going to work to understand your business as well as you do, right? And their willingness to lend to your business is going to be based on your ability to articulate the understanding. So, as I said, you'll want to provide, the projections. And then if you are an existing business, they're going to rely on what they call the existing debt service coverage, right, from the operating business. Typically, banks operate at a debt service coverage threshold, and I'll explain this, at 1.2 times, right? So what that means is, if your loan payment is $500 a month, the bank is going to expect you to have available cash flow of $600 a month after all of your business and personal expenses are paid in order to satisfy that debt, right? Um, most most major financial institutions will offer an SBA Express loan or some sort of SBA product. They may know it as a 7A product, but as you start working directly with the SBA, Wintrust is an SBA approved lender. So we underwrite these SBA Express loans in-house, and we don't have to go through a third party for that particular product. If you're looking at, different products like an SBA 7A or a 504 loan, you can still work with Wintrust, but we will participate with a third party organization that's called the CDC, who provides the SBA's guarantee capital. The other product that is more specific to Wintrust that we offer is called the Easy Access, either line of credit or term loan. Again, term loans are specifically for you acquiring assets, right? So if you're acquiring a vehicle, if you're acquiring equipment or real estate, you're always going to want to fund that with term debt. And what I mean by term debt, it means that it's money that you receive all upfront, and then you begin making principal and interest payments on that money over a given period of time until the debt is paid off, right? The reason that you want to use term loans or amortizing debt in order to acquire fixed assets is because they have a finite useful life. And what you don't want to do is only pay interest and never reduce a principal balance on an asset all the way until the bank says that the loan term is up. Because at the end of that period, you'll have given the bank free money because they still need to get paid off for the upfront money that you gave them, right? So you don't want to use the second product, the line of credit, which is an annually renewable interest-only facility to acquire a fixed asset, right? So let's say, a vehicle depreciates from the moment, a brand new vehicle depreciates from the moment you drive it off the lot. You fund the acquisition of that vehicle with a line of credit. The bank is only charging you interest on the amount that's outstanding, right? It never requires you to make a principal payment until it looks to renew the line of credit and decides that you haven't managed the line of credit properly, right? A line of credit is really a tool for you to front fund expenses that you expect to be paid off on within a 12-month period, right? So if you are doing a job for the city of Chicago, right, we know they're notorious for late payments. It can be 30 days, 45 days, 60 days. So the benefit of a line of credit is, let's say, you're approved for a $250,000 line of credit with us, but you need to make payroll for the next 2 weeks or the next month. Well, that may not cost you $250,000. That may cost you $30,000. What you'll do with a line of credit is you'll advance that $30,000 to make payroll. And then within the 30 days or 45 days that the city or the state pays you, you can use the proceeds from that payment to reduce the balance of the line of credit. So now you've got a full $250,000 available again, and you're not paying for the access to that money, right? You've only paid for the interest. Whereas if you were to use that facility to acquire a fixed asset, you're only paying interest. The vehicle itself isn't going to recoup its value in that short time frame. So when the bank gets to the end of the year and they look at whether or not it makes sense to renew the line of credit, they're going to term it out anyway. And you'll have given the bank that period free money, essentially, right? I can kind of ramble about this all day. I think these conversations are better held when folks ask questions that are specific to what they have going on. So with that, I'll kind of take a pause here and see if there are any questions.
I actually have some questions for you.
Sure.
So, there's oftentimes, two types of businesses that operate in this space, right? So there's the more established business who has built relationships, built contracts and such who can actually benefit and, make projections based upon some of the paperwork that they have in place, right? But then
Right.
you have the guy who might have one truck who doesn't have a static contract, but may have some broker relationships, and
Hmm.
they're really just trying to build on that. So in terms of going to a bank and saying, look, I have this business that I'm operating, what type of documentation do you think they should be prepared to bring?
Well, so I think one of the keys is when you say established, you start with how many years have they been in operation, right? So if it's 12 months, you really want to look, you're at 12 months of operation, typically you're going to need to either go through the SBA, right? And you're going to have to do the due diligence necessary, right? To kind of put those projections in place, right? So if you have these brokered relationships, can you prove that these brokered relationships are renewable, right? Based on letters of intent, right? So the projections, especially for a newer business, become even more valuable, right? Because they can only rely on limited performance information. They're also going to rely more heavily on the individual solvents of the guarantor or the operator individually. So what they'll want to bring to the table is they'll definitely want to bring their 3 years most recent personal tax returns, whatever business tax returns that you have available, whatever year to date profit and loss statements and balance sheets, and then those projections, right? Um, it comes back to, especially with newer businesses, it comes back to the amount of debt that you're applying for and how much you're able to pay for in real time. Because even though the bank is going to look at your projections, they're only going to lend on what they believe that you can pay on today, right? So the best thing to do is to have that upfront conversation before you go through the due diligence of compiling documents, is to have an upfront conversation about your unique situation so that you can be told specifically what to bring. You'll always need to have the most recent business tax return. You'll always need to have the most recent personal tax return. But depending on what it is you're trying to do, there are additional documents that you can use to support your case that the bank is going to need to review.
The next question I have is, I see, existing dump truck companies, whether or not they're mom and pop shops or if they're, larger established companies. But then I also see a third type of company, which are over the road companies, right?
Okay.
Who are maybe looking to come back home. I just saw a report yesterday that due to rising fuel costs and lower contract values, a lot of over the road companies are starting to downsize, right? So I see that as a viable company group that might look to go into other industries that are within trucking. If that were the case, and I am that company, what type of documentation in that sense do I need to bring? Because I've shown revenues, but I'm also changing markets.
Yeah, so you're going to want to show that, so management experience, right, and capacity are things that the bank considers heavily, right? At that point, the bank is going to rely on a combination, right, of the two that we discussed, right? So you've proven that you have experience, you've proven that the business can generate revenue. You may even be able to support the debt, in real time. As you transition into this new phase, what evidence do you have of the new relationships and the new contracts that you've developed, right? Locally or domestically, that'll show that you'll be able to generate the equivalent threshold, right, to where you were, or to prorate it to a smaller scale based on you not doing, over the road trucking. Specifically in trucking, because it's so dependent on the capacity of the operator, right? Their relationships. The bank is really going to dive into your narrative, what your financials are. They're going to want to know what your plans are. As an institution, we'll ask for a business plan, but we're not really looking for, the 40-page explanation, right? We want to know what the financials say as far as the projections are concerned. We want to know who's managing the company, what have they done, and what confidence and what confidence can they share with the bank that they'll be able to generate that threshold? Those core documents, right? The financial documents that you'll always need to bring to the table are, the business and personal tax returns, year-to-date profit and loss statements. I will say that for your business line, it's really important that you have a conversation with your accountant about whether it's a cash-based accounting or an accrual-based accounting, because it can affect what your tax returns look like. You'll need to communicate that with your banker so that they can also request your internally prepared financial statements that'll show what that difference is, right? So what I mean by that is a company that's really a $3 million a year company can look like a $2 million a year company, depending on the timing of them being paid for contracts and when those contracts were originated.
Very last question, and it's actually a twofer. So I see a very last segment of the market, which is, hey, look, I'm a brand new CDL, or not a brand new. I've been driving trucks for some time. I have my CDL. I have a great track record, but now it's time to jump out on my own, right? What type of documentation? How supportive are banks to that type of situation? And then, in a real sense, how can we at GWO be a partner to that person who's interested in going? What type of support can we be to help them work along with you?
So again, the management experience piece is crucial, right? So them being able to rely on that, and then being able to anticipate what kind of loads, right, they can generate within a defined period of time, right? Also understanding, what kind of funding they're looking for, right? So if we're just talking about them acquiring a vehicle, right? Again, it's going to be based on what you can afford now, right? But those being able to price out, right, what they expect to generate, and then being able to do the same thing for the expenses that they're going, to incur. So I think that that's where a group like GWO was invaluable, because you can let them know what the numbers are in real time based on what they bring to you as far as their capacity. So if I was working for a company, I've developed relationships with 11 different organizations that say that they like me and they're willing to give me a shot. How do they extrapolate that into financials, right? What does that budget look like? And then being able to provide us with that budget only lets us know, it gives us confidence, right, that they know what they're doing, because the assumptions at that point become validated.
Okay. And if anybody were in the any of the groups that we mentioned, how would they get in contact with you if they say, look, I have things together, I'm ready to go, I just need to know who to contact?
Sure. So, my name is Jason Swan. You can give me a call in the office at 773-987-3237. I work from my cell phone at 708-252-0998. And my email address is jswan@thebeverlybank.com. I typically work out of 3 branches primarily. So I work out of a Hyde Park branch on 53rd and Lake Park. I work out of the Beverly branch at 103rd and Western. I work out of the Evergreen location on 95th and Pulaski, and I work out of the Pullman location on 115th and Halsted.
Okay, thank you so much, Jason. And very, very last thing, Jason was the very first banker that we approached when we tried to get into business. And funny enough, he actually denied the loan. He worked hard to get it, but it was denied. And if history serves correctly, it was for good reason, because we were very new and we would have been in a lot of trouble had we got that loan. So in a weird way, I'm very appreciative of that, Jason, and thank you so much.
Thanks for having us, guys. You guys are a shining example of what we want to see small businesses in our communities become. So if there's ever anything else I can do for you guys, please let me know. Have a great rest of your Saturday, everyone.
Thank you. Thank you.
So next is Doug O'Neill. Doug is actually our insurance agent. He's been our insurance agent for some time. And, I think that this is important. Insurance is a very important part of trucking. And it helps to have someone who can actually navigate you through that process. The entire dump truck university itself was more or less born out of a conversation I had with an owner operator who was working along with us, who had he was paying way too much in insurance, and I said, look, we can find a way to get the message out that you can operate in this industry and don't have to spend an arm and a leg. So without further ado, Doug O'Neill, I'm actually about to share my screen so we can show his presentation. Good morning, Doug.
Thank you, Ricky. Good morning, everybody. As Ricky said, I am the insurance agent for GWO Trucking. I work for Ram Insurance Agency out of Lockport, Illinois. I've been doing this for about 30 years, and we specialize in insurance for truckers and contractors. So we've seen it all over the last 30 years, and we're currently in a market that is extremely tough from an insurance standpoint for truckers of all stripes. So I wanted to talk today a little bit, maybe for 15 minutes or so, about some of the things the insurance companies are looking for, some of the things that are driving the prices, and some of the things that you can control to help control your pricing over the long term with these insurance companies. So with that said, we can move on to the next slide.
Okay.
And
there we are. Cool.
Look at
can you guys see it?
The main factors affecting insurance costs. This is what the insurance companies look at when they first see your account. And a lot of you may know when you first start in this business, you don't get a lot of consideration. The reason for that is there's just not a lot of competition, and competition, the lack of it, will drive up the premiums. In Illinois currently, if you are in business less than 3 years, there's really only 2 insurance companies that are willing to quote your business. Now, there are exceptions. I'm sure there are people that have been able to get insurance from somebody other than Progressive or National Casualty, National Indemnity, if they're in business less than 3 years, but that's an extreme exception and really, really rare in the northern part of Illinois. Cook County and those areas are extremely tough. So 3 years in business, you got to tough it out before you'll get any of the better insurance companies with more competitive pricing willing to quote you. So, after 2 years, maybe try to get quotes. More than likely, you won't be able to come up with anything much more competitive. But after that 3rd year, you should really be pressing your agent to go out to market, come up with as many quotes as possible, and just verify that the deal you're getting is the best available on the street. If you've had good experience of those 3 years, you should probably be moving away from Progressive and to a more competitive company. The second item that they look at is credit history. They'll look at the corporate D&B scores. They'll look at individual credit scores as well. So if you are married or have a partner that may have a better credit score than you, you need to be checking with your insurance agent to see if there is an individual tied to the credit scoring, and if so, who that individual is. There can be premium differences based on which individual they run the credit score on. I recently did one between the husband and the wife. They had different names, but they were married, and her credit score was significantly better. The pricing difference was almost 25% with the insurance company. So that can make a difference, something you should look at. Garaging location, probably not something you have a ton of control over, since you're going to want to be near where all the work is. But in Cook County and Chicago, you're going to be paying the highest rates. If you can get out into the suburbs or rural, you can see rate decreases of upwards towards 50%. And always make sure that that address on your policy, that garaging address, is accurate down to the zip code. There can be differences in rates in individual zip codes, especially outside the city of Chicago and in suburban Cook County. Another item, radius of operations. A lot of you guys are doing local hauling, doing sand and gravel, and that's fine. That's the cheapest rate if you're under 100 miles or 75 miles for some insurance companies. Once you start going over that, they'll start surcharging your rates 15 to 20%. So if you just have one customer that's making you go farther, it may not be worth it to do it. You might be better off just staying in that local radius and focusing on the business that you're going to be paying the lower premiums on. Additionally, if you have a US DOT number crossing state lines, you're also going to be surcharged on the policy. So if you don't need to be crossing state lines, you don't need a US DOT number, you are probably better off the first few years just operating interstate only inside of Illinois with just the ICC operating authority. That can keep your rates down as well. Once you get away from Progressive or National Indemnity after a few years and you want to apply for that US DOT, you won't be penalized as much as you are those first 3 years. The reason for that is once you have that US DOT number, it authorizes you to go as far as you want. You might have said you're only going 50 miles or 75 miles, but once you have that authority, the insurance company knows you can take a load anywhere, and they're going to want to charge you for that exposure. A big issue these days, I'm sure everybody knows it, it's driver acquisition, hiring, training, and all that. It's one of the main pain points I know for all you truckers. It's also a pain point for the insurance companies. I think they are probably one of the obstacles for you guys getting more drivers in the seats. But their reasoning for putting these restrictions on is because of losses. And what they are finding is that it is highly predictable which drivers are going to be causing accidents based on their age, years of experience, and past violations or accidents. Individuals that are under 24 years of age are very hard to get approved with most insurance companies. And if they do approve them, there will be a surcharge. Same with lack of experience, less than 2 years of experience of a Class A CDL operating those heavy tractors. That's frowned upon. Again, they can surcharge you for that lack of experience. These surcharges can be, 25, 30, 40%, depending on the driver. And if you have a combination of youth, lack of experience, and violations, you could be paying 60, 70% surcharges on those individual drivers. I understand the need to get the trucks moving, get the people in those seats, but you've got to really screen these guys well and make sure you're putting the best people in there, because the statistics show these are the people that will be causing the accidents. If you're under 24, have lack of experience, or have had prior accidents or speeding violations, you're likely going to have the same types of incidents going forward. Fleet size is another factor that insurance companies look at. They prefer, actually, a lot of them writing accounts that are 5 units and up. They consider 5 units and up a fleet. Some cut off at 10. Once you have what they consider a fleet, they feel like you're a more established company, you have more established procedures, and you're going to be running the business in a more effective way. Credits can range from 15 to 25% once you get over that cutoff on the fleet size. So there is benefit to being a little bit bigger once you get established. Next slide, Ricky.
Okay.
So there are a few things that you should really be focusing on to control, help you control your insurance costs. Vehicle maintenance, driver hiring and training, and the types of coverage you're carrying, obviously. Any operations outside your normal dump operations, and then the technology that's available today to help, tracking your vehicles and drivers' behavior, things like that. They refer to that as telematics. And there's a whole suite of services that can, provided by these vendors today. With regard to vehicle maintenance, these insurance companies want to see pre-trip inspection forms being completed by drivers on a daily basis. They want, the more heavy maintenance scheduled on a regular basis and documented. And they encourage truckers to have reward programs for drivers that have clean inspection, result of, a USDOT, somebody pulling them over and checking the vehicle out. So having those things in place, highly critical. They will look at violations, out of service and things like that. And if there's a history of poor brakes or tire treads, things of that nature, it'll either cost you more money in premium, or they may just refuse to quote outright. We talked a little bit about driver hiring and training. Again, age, experience, and that motor vehicle report are key. But you also need to look at, keeping and retaining drivers. Obviously, it's huge. Insurance companies don't like to see turnover in drivers. They view that as a sign of other issues internally within the trucking company. So retaining drivers is key. If they see that you have more than 25% turnover in your driver's schedule, they'll probably surcharge you or want to find out what's driving that turnover. With dump trucks, it's not viewed quite as critically because it is more seasonal in nature, and they do understand that there is more of that in that segment of trucking, but it's something to consider. There's also defensive driving discounts and safety training discounts available from a lot of insurance companies. If you aren't documenting safety training or defensive driver training for your drivers, you might want to talk to your agent to look in to see what types of discounts could be available if you send your drivers to do this. It could be something as simple as a 15-minute webinar online. A lot of times it might be free, depending on who the vendor is. But as long as you can put all your drivers through it, show the certification that they completed it, you may be able to get discounts from your insurance company for those types of programs. Always worth looking into. You should be encouraging your drivers to have accident-free years with reward programs. So if they go a whole year without an accident, maybe there's a minor bonus involved or something like that. It's another good way to retain those drivers, help driver turnover, and it's a good thing to show the insurance company that you're serious about safety and preventing accidents. And on the flip side of that, not having the carrot, but you got to have the stick. You got to have a disciplinary program in place. The insurance companies want to see, what are your standards? If he's involved in 2 accidents, is he going to be terminated, or does it take the 3rd accident? So they're going to look at how serious you are about enforcing those safety standards. One of the things you could also do is look at your coverage. Maybe you're carrying too much. There's probably not a ton of savings here, but one thing to consider for dump operations is cargo coverage. The ICC allows you to file an affidavit to get out of carrying cargo coverage if you so wish. That can save some of you, especially newer in business, a couple $1,000s a year in cargo coverage. You'll have to keep in mind that if you file that affidavit with the ICC saying you don't have any loads valued at over $5,000, that if you do spill a load, you will not have insurance coverage to pay for the cleanup costs. So you are, in essence, accepting that risk yourself by not paying that cargo premium. If you have 4 or 5 vehicles on the road, that premium can get up to $3,000 or $4,000 with some of these insurance companies. So it can be a significant savings. Look at some of the other premium charges on your uninsured motorist, your medical payments, comp and collision coverage. Some of those charges can be reduced. It doesn't amount to a lot, but it'll add up over time. Look at your deductibles. I suggest going as low as you can. The premium saved, the additional cost to lower your deductibles is not that much, but if you have a claim, you'll make it up. The difference between a $2,000 and $1,000 deductible is usually only a couple $100 a year. So it might be worth it to just carry the lower deductibles. And another thing to look at is winter layup. If your insurance company allows you to lay up any vehicles that are not in use, that is a huge savings for people in dump operation, because a lot of those vehicles will set for months on end. And if you have any maintenance issues or anything like that that go on for weeks or a month, then you also could lay up a vehicle and save premium. Progressive and National Casualty, those companies that are quoting the newer in business, they will not allow this. It won't be until you've been in business for 3 years and you get with a Country Companies or an Acuity or a Pekin or one of these better standard companies where you can get that benefit of winter layup or just layup. Try to avoid non-dump operations. The insurance companies, you'll find one insurance company likes dump trucks. You'll find another insurance company likes intermodal. You might find one that prefers reefer or dry van. You know, they all kind of like their own thing. Think they understand it better than others. So when you start mixing your operations by hauling intermodal goods or reefer goods or lowboy or flatbed, you're becoming less attractive to that insurance company, which ultimately will result in higher premiums. A lot of it's like the one load or one customer you have where you're crossing state lines and going extra farther, and now your premium's rated at higher mileage. Is it worth it? You can get a couple loads of this flatbed stuff, but is it going to be worth it? How's it going to impact your insurance? Most of my insurance companies that write dump trucks do not like flatbed or lowboy. They'll own a very small percentage of it. And if I had to move some of those people to markets that like flatbed or lowboy, the insurance premiums oftentimes go up 50% or more. So really consider whether or not it's worth it to diversify and go outside of that dump truck operation. Talk to your agent. Telematics and cameras, things like that, GPS, it's something that you really should consider putting in all of your vehicles. I think the time is coming when the insurance company is going to require this anyway. If you don't have them, they aren't going to even quote you. The services are becoming cheaper and cheaper. The hardware is becoming cheaper and cheaper, more universal and easy to set up. So there's almost no excuse anymore for not having, some of this stuff in your vehicles. I know Progressive, for example, they will pay to have the stuff put in your vehicles, and you can receive credits of up to 15% a year, depending on the metrics that they're providing. Those insurance companies that provide that stuff will access it. They'll look at your braking, they'll look at speeds, they'll look at all kinds of metrics, and they'll see exactly how you're driving and calculate a credit for you based on how good it is. The premium will never go up, but you can receive a discount. So they're paying for the product. It's easy to install. They'll monitor your drivers. And at the end of the year, you can get a credit for good driving practices, and the premium will not go up. So definitely consider installing those in your vehicles. It will make you a much more attractive risk to the insurance companies, and it will ultimately save you money in the long run, either through claims or things like that. I've seen cases where these front-facing cameras have helped the insurance companies defeat claims. These attorneys and everybody else always go after the deep pockets of the trucking companies. The trucker's always at fault and has a hard time proving they're not at fault. But these cameras go a long way to doing it. We've seen it happen. It can be successful. And having those claims not show up on your, loss history is critical to staying in good standing with the insurance companies. That brings us on to the next point on the next slide. Ricky, if you could.
We're on the next slide.
Oh, okay. I think I had one more point that didn't make it on the last slide, but that is your claims history. What a lot of people don't understand with the insurance industry is that, these companies, insurance companies, have so much overhead and expenses that by the time they're done paying all their employees and, everything for their buildings and all that stuff, they actually only have about 40 cents on the dollar left over to pay claims. So if you're running a 50% loss ratio on your business with the insurance company, they're looking at you as being almost not profitable. So, you might feel like you've paid in all this money, but in the insurance company's eyes, less, almost half of that is not even available to pay claims. So you got to keep that in mind. They also look at things frequency versus severity of claims. Okay, the number of claims you have versus the size or severity of the claims that you have. They look at frequency worse. If you have a lot of small claims that don't total a whole lot versus one big claim, they prefer the company that has the one big claim. Because what they say is that all these small claims tell me that you're going to have the big claim also. So if you have these small claims, you're better off sometimes, depending on how small they are, paying for them out of pocket. You know, if it's just property damage and there's nobody injured and you can settle it quickly, you're probably better off paying for that out of pocket than turning it into the insurance company. Because once you have a number of these small incidents on there, the underwriter at the insurance company look at it and say they're due for a big accident, and they will hold that against you worse than if you had just had one big accident. The other thing to look at is the accidents that you have had. Are they all coming up as a result of rear ends? Is it lane changes? You know, what are the circumstances that are leading to these incidents? And maybe those are areas that you can work on additional training. The insurance companies oftentimes will ask, what have you done to avoid these types of things happening in the future? So defensive driving courses, toolbox type talks where you just have a quarterly or monthly safety meeting and you bring up, you know, examples that your drivers can bring in that have happened to them on the road and help teach each other what to look out for, things like that. You have to be able to tell a story about these claims and what you're doing to make things better. You can't just say, oh, it's an accident. Accidents happen. They want you to take this stuff seriously. So corrective actions are key. The other issue is subrogation claims. These are claims that you've had, accidents you've had that aren't your fault. Maybe you want to get your vehicle back on the road as quick as possible, so you turn it into your insurance company and you want them to recover the money from the guy that's at fault. A lot of times they can't get the money back, and the claim ends up on your loss history and you get punished for it. A good agent will help you file a claim with another insurance company and help you recover your costs. Without having to go through your own insurance company and risk that claim showing up on your reports for up to 5 years. So consider going directly to the other insurance company if you are not at fault. Try not to file it with your own insurance company. And then that final or second to final factors affecting insurance costs, what you can't control. You know, market conditions. We're, like I said at the beginning, in a very tough insurance marketplace. There's not that many insurance companies quoting truckers, and the ones that are really getting their pound of flesh. We're seeing increases year over year, 10, 15% on good clean accounts. The only ones that are escaping those size rate increases are the very large truckers. Anybody in the smaller fleet range, 10 to 15 is normal. If you've had incidents or accidents, you're probably seeing increases still 20 to 25% range. This is all a result of years and years and years of the insurance companies losing money on commercial auto and more specifically on trucking in general. If you look at the industry as a whole, if you take all the insurance companies writing truckers and commercial auto in the United States, they have had a loss ratio over 100% every year since 2010. That's 12 years of them losing money on commercial auto. They don't like to lose money. They're chasing this with higher and higher rates every year. I don't see it changing. I think it's going to continue to increase year over year over year. We haven't even seen inflation start to affect insurance rates yet, but what I'm hearing from the insurance companies is that their claim costs as a result of inflation, that's, you know, labor and materials for parts and things like that, are going up more than 20%. So you're going to continue to see rate increases in the foreseeable future in that range on your book of business, on your policies for at least the next few years. So it's important that you address all these things we talked about previously today to keep your costs down. you're gonna need to do it. Otherwise, your premiums are gonna put you out of business. I've seen that happen. It's not pretty. So you have to do everything you can and control what you can. Does anybody have any questions?
I actually have questions, Doug. Let me stop sharing. If anybody wants Doug information, is right there on screen before I get to the question. But let me ask you this question, Doug. What is I know every scenario can differ, but let's say we're comparing apples to apples in terms of experience, driver experience, loss rate. What real difference have you seen between the over-the-road companies and then also somebody who runs a comparable dump operation?
Right. I mean, the premiums in general for over the road, because of the miles, the radius of operation, are higher. If you have a over the road, all other things being equal in the city, garage in the city of Chicago, Cook County versus a dump, the premiums can be almost twice as high. So newer in business, relatively clean dump guy in Cook County, city of Chicago, probably paying, with a really, really, really good insurance company, $8,000-9,000 a year versus like Progressive, which can be 13, 15, 16, 18. The over the road guys are, 23 and up, 23,000 a year per unit. And that's if they're good. So I've seen premiums $32,000 a year for an over the road guy. So it's very, very expensive. So I've seen a lot of these guys come back also. And the guys that I have that are still running, they are running half their fleets because they, combination of fuel costs, insurance costs, drivers, it's a very, very tough environment.
And just to be clear, we're talking about 23 per unit, right?
23,000 per unit and higher. Yeah, for the over the road guys.
Okay. Last question.
Yeah,
go
ahead.
I'm sorry.
No, I was going to say it makes the when you pay 12 or 13 for your dump, it sounds crazy, but compared to the over the road, it's still quite a bit lower.
Right. Last question. I'm an over the road guy, and I have 5 trucks, but fuel costs, like you said, are eating me up, and I want to try one dump. I'm becoming dump curious, right? How do I approach my insurance guy with that question?
Yeah, I mean, you're going to definitely want to be sure your insurance company is okay with the dump operations. I mean, it's viewed completely different than the over the road from an underwriting standpoint. You may find your insurance company isn't okay with it. I know Progressive will do the mixed fleets. Some insurance companies will, but that's your first step. And second is basically just making sure that you've got, the good drivers that know that industry. I don't think putting an over the road guy into a dump necessarily, I don't know, if that's going to work or not. You probably could answer that question.
Yeah, I mean, everything is driver dependent.
Yeah.
I tell people that as long I could teach my daughter how to dump, it's more or less, if the person is actually going to listen, actually pay attention to their surroundings, and then be able to swing their short trailer. So, but with that said, I mean, we are actually at the hour. Thank you for your time, Doug. I know Jason is gone, but we appreciate his time, and thank you for everybody who signed on.
Thank you, everybody. Have a great Saturday.
Thanks.
Thank you.